Hey everyone, today we are talking about what it means to be above trend but not in a bubble. The US economy is showing surprising strength again, with inflation cooling a bit, markets are setting new all-time highs, and optimism appears to be everywhere. We're also hearing lots of emotional talk, some from folks getting caught up in the excitement of things, while others are still waiting for that inevitable correction to show up. And in today's episode, Brian and I will unpack what's really happening in the data, how we're thinking about markets now that we're about 12% above the long-term trend, and how to balance between greed and fear. We'll also share some year-end planning ideas on the tax perspective around tax loss harvesting and tax gain harvesting. And most importantly, we'll look at what Scripture teaches us about contentment, humility, and wise stewardship in seasons just like this one.
Welcome to the Wealth and Wisdom Podcast, where intentional planning meets eternal perspective. It is October 27th. We're glad you took the time to join us today. I'm Brian Cochran, and I'm joined here with Leonida. We're part of the John Moore Associates team, helping to serve wise and generous families. Just really glad you're here and joining us. Just so much going on right now, isn't there, Cole? I mean, just politically, economically, market-wise, I feel like each week we have to really distill our broad conversations in our investment committee. But what stood out to you this last week that's maybe to kick us off here?
Yeah, well, the big news last week in the macroeconomic landscape, it's been pretty slim pickings on that with the government shutdown, but we did get the CPI, the inflation numbers last week, and they were surprisingly good. We're seeing inflation kind of slow down a little bit. We're seeing the economy continue to show strength. And growth is showing up, especially in company earnings that we're getting. We're right in the thick of earnings season, and things are looking generally pretty strong on all fronts. We're also seeing the market expecting 2 more rate cuts this year. We're looking at I think I saw a 97% chance of a rate cut in October, and then we're also looking at a 96% probability of a rate cut in December. Again, the bond market's been wrong before, but we're seeing a lot of likely tailwinds for risk assets like stocks, and this is coming while we are already 12% above the long-term trend. That can be a little bit scary for some. That can be fear-inducing, or it can be greed-inducing, where people feel like they're fearing that they're missing out on the run-up, or people are fearing that there's the inevitable fall on the other side of this above trend. What I'd like to do, Brian, is I'd like to take a look at our trend chart that we often reference with clients, and we'll do a deeper dive on this next week. We'll do our full monthly market update, so you will see this again. I'm going to share my screen. So we find ourselves about 12% above the long-term trend. As I mentioned in the open, we don't consider this a bubble. This is just above trend. Markets are continuing to look a bit expensive by our measure, but where we are right now, about 12% above that trend line. Compare that to the dot-com bubble in the late 90s. This was about 100% above trend over here. This was a bubble. In hindsight, obvious bubble. Today, not an obvious bubble. And we've got companies that are producing really strong earnings reports. Brian, do you want to talk about what we're seeing in the corporate earnings as we're about a third of the way through the S&P 500 earnings?
Yeah, it's been positive. We're getting more surprises on the positive side than the negative. And what we're seeing in our data is each week the earnings forecast for the next 12 months. So as analysts and companies start to look out into the new year, we're seeing those forecasts rise steadily. So good news on top of good news. So we're getting the results from last quarter were positive, and we're getting forecasts that are higher than they were previously. Now, if you'd asked me, let's say 2-3 months ago, Cole, how's next year looking? I'd say, okay, the end of this year and into 2026 is okay. But now we're starting to see really strong numbers. We've gone from sort of 5 to 7% earnings growth to more like 7 to 9% earnings growth for the next several quarters here and then double digits maybe into next year. So you're seeing this earnings momentum, this push. So that's part of, as you were talking about comparing the current market to a bubble, one of the signs of a bubble is that the prices are going up way faster than the earnings that might justify that change. And that's not what we're seeing now. We're seeing earnings that really back up prices. Now, that doesn't mean every stock in the market is fairly valued. There's certain sectors or certain companies that might be expensive in this environment, but we're seeing a lot of positive momentum. So that's encouraging from our view. It gives us more stocks that we can look at buying because they look fairly valued, and it means that the stocks we have today we're willing to hold because they don't feel like they're in a top or a bubble.
Yeah, and I think that's a really good point. We've seen relative low volatility most of this year, and then it's actually been suppressed over the last couple of weeks in both the stocks and the bonds. And really where we're seeing earnings right now is we're about 30% of the way through the S&P 500 on earnings. And we're seeing the companies that have reported the average year over year earnings number is about 15% the companies are reporting. So we are seeing companies that have been very profitable. We're seeing really good reports coming out right now, which is almost double what expectations were. That is blowing expectations out of the water. Almost 85% of companies that have reported so far have beaten expectations. And that's even more pronounced in the small cap space, in the Russell 2000. We're looking at, so far, the companies that have reported, the earnings growth rate on that has been 25% year over year. Admittedly, that's because it was really bad a year ago. So the year over year comparables are very easy to beat, but those are substantial growth rates, which again kind of backs up and reinforces this bullish trend on the market, this run up in the market. It is backed up by very strong earnings reports so far in earnings season. So moving past that, Brian, earnings have been good. We see inflation kind of cooling off a little bit. We're expecting some rate cuts. All these things are very positive for the market. What else are we seeing within the macroeconomic environment or within the market that is noteworthy for investors right now?
I think what we see is just the economy is in still pretty good footing. We had a little bit of shaky ground, I think, in the last few months, but we're seeing deals being made, U.S. and China trade deals that support continued economic growth, not just in the U.S. or China, but that supports global activity across all sorts of industries. We're seeing just a good broad-based rally across all sectors. So I think that supports this idea that just the macroeconomic picture is strong. We do still have that concern we've talked about in the past of this sort of K-shaped economy where those with assets who own stuff, real estate, stocks, bonds, cryptocurrency, gold, you name it, whatever you can own, those folks are still benefiting from this economic development, but we're still seeing that lower half of the K, sort of you think of the K shape. So you've got the high income earners doing well and the bottom half struggling. That is a great concern, not just economically, but obviously socially. We want our neighbors to thrive and to have financial stability and peace. And that's not the case right now. We're seeing that continued strain on the lower half of that K. So that's worth monitoring, and it also could affect your investment themes, right, of what types of companies you want to own, what type of sectors may thrive in the coming years. And I think the temptation there, Cole, is that to let government fix that. And there's different sides of that argument. But there's definitely a tension forming economically that we talked about this morning in our committee that will be worth watching.
Yeah. And one place that kind of shows up, there's an index that CNN has, the Fear and Greed Index. We've referenced this before. Right now, it's on a scale of 0 to 100, 0 being extreme fear and 100 being extreme greed. It's currently at a 37, which would be firmly in the fear category on the left side of the knob. That to me is interesting because markets have been incredibly strong, and we've seen some of that investor confidence, pushing towards the small cap space, which those only perform well when people are thinking very positively about the direction the economy will be going. So there's a tension here where we're above trend And we're seeing that some people, some of our own clients, or just you click on a particular news channel, you might get the pound the table, this is going to go up, we're going to the moon, that sort of language, that greed, fear of missing out type language. And then on the flip side, you might hear the more bearish side of things where it's like, hey, what goes up must come down. When's the other shoe going to drop? And how do we navigate that tension? What advice might you offer to, maybe they're not a JMA client right now. What advice might you offer in a time like this? Maybe some scripture, maybe just some principles that we share with our own clients.
Yeah, great question, Cole. And it's a good reminder that we like to talk about markets, but we don't serve the stock market. We serve people. We serve families. And people have emotions. We have these functioning human brains that tend to betray us a little bit when it comes to economic decision making. Behavioral biases is what we talk about. They show up in times like this. And I think that's one of our greatest concerns that we frequently talk about in our committee is not just where's the market stand or what stock should we buy or sell, but how are our clients doing? What are we hearing from clients? And what I hear is what you talked about, sort of this dichotomy where, and it kind of signifies to me that we're not at the top yet. And the reason I say that is you still have so many skeptics. So we have those clients. I just got an email this morning, right when we came out of our morning investment committee. There's a client who said, my account's at this certain benchmark she always looks at. And, should I get some out before it drops? Like, that's not bubble behavior. That's not bubble behavior is buy more, I'm going up, and you do have some of those. So I think you've got the fearful people who think this is a top, and then you've got the overconfident or the FOMO crowd, right? The crowd that missed this, and now they want to buy whatever stock has done well the last 6 months, and that's very dangerous as well. So my advice there, when you ask about sort of what do you do about that, this is a little self-serving, but it's the value of a financial advisor. You need an objective third party because we all have these human brains that can betray us, and we need to be able to separate our feelings from our thoughts and our feelings from what's true. We could feel like it's a bubble or we could feel like we're missing out, but that's not necessarily the case. And it's sort of like why we have counseling and therapists and friends that we can bounce ideas off of, because sometimes our feelings betray us, and that is so true in the world of economics and finance. So my biggest advice would be to have somebody who's an accountability partner that is removed from your portfolio. They don't have the emotional attachment to your favorite stock. They don't worry about whether or not their retirement's going to thrive or struggle. There's basic principles and there's good technical data here, but in the end, you need somebody who can be the emotional crutch and help you avoid making bad mistakes, which in this case could be either way, getting all in or all out of the stock market, being overly aggressive or overly cautious. And we love to serve that role. I think our advisors are really well equipped to do this because we talk about it a lot. We train on it and we discuss it, and many advisors would feel the same. And Cole, you mentioned scripture. There were a couple verses you talked about this morning that came to mind. Do you mind sharing those that really give us that timeless wisdom around fear and greed?
Yeah, the one that comes to mind really on both sides of this, Brian, is that there's fear of things going down, but there's also that fear of missing out, which can be, greed. And really 2 Timothy chapter 1, verse 7 comes to mind for me. For God did not give us a spirit of fear, but gives us a spirit of power, love, and self-control. And self-control can be really hard when emotions come into play, and there's really no money decision that doesn't have an emotional tie to it. And fear can manifest on either side of this fear that you're not making enough, or this fear that you're going to lose more than you can. So having a disciplined approach, having some accountability from an advisor is a really powerful thing that you can't really measure or quantify, though some institutions have tried to quantify the behavioral value in terms of performance. But really, it's a feeling. It's an experience that when you work with an advisor that's been through it before, that has that steady guiding hand, that can just be invaluable, and it will eventually show up in investment performance. But really, it's a peace of mind that comes from not having to second guess your own thoughts, decisions, because you're feeling the emotional pull. Man, I knew it. The armchair, the Monday morning quarterback. I knew I should have bought that stock yesterday because it went up 15% today. Or I knew I should have sold that. It's an easy trap to fall into that, admittedly, sometimes individuals on our committee can express that sentiment, but that, again, is the power of the group, the wisdom of the group that doesn't allow us to fall prey to the fear or the pride, thinking, I knew that was coming. No, you didn't. None of us know what's coming. Oftentimes we'll say that, John Moore, took his crystal ball with him when he retired from JMA. There is no crystal ball, and anyone that pretends like they they have one is lying. And Brian, what's the biblical punishment for prophecy gone wrong?
Yeah, we always joke it's death by stoning is the biblical penalty, and we live in the desert where there's lots of landscaping rocks right outside our office, so I'm not interested in subjecting myself to that. And you mentioned that word pride, Cole, and it brought up Proverbs 11:2. When pride comes, then comes disgrace, but with humility comes wisdom. And I think of that's kind of a cycle, right? Pride, then disgrace, then humility. And wisdom. And I think of a couple of our clients that were managing their own stock portfolios last year, and they were coming in late last year when the market had been strong, and they were bragging about that pride came in, how smart they are, and look, I'm making a better return than you are, and you're the professionals. Look at me. And then coming in with their tails between their legs around April when the market corrected hard, and a lot of their positions lost 30, 40, 50%, and there came humility and then wisdom. That maybe they were taking this a little too far in terms of risk, that they had some lessons to learn. So I think it's a cycle that most investors have to experience for themselves. We could preach about it for the next 20 minutes. We could send you a million books, but it's one of the benefits of starting small as an investor is you can make those mistakes and feel that pain and the joy and the ups and downs of the emotions of investing small. So then when your scale is greater, you have the opportunity to impart that wisdom on your portfolio. But if you don't have that, then that's why we're here. It's a huge part of our role. Again, aside from the technical aspects of what we know and what we do, the behavioral aspect cannot be undervalued or underestimated in terms of its influence. I can't tell you, Cole, I've been doing this almost 20 years. I can't tell you how many clients I've talked off ledges in terms of making bad decisions with their investments and their financial plan. It really is a big deal. And when people ask in a crazy market if I lose sleep, and I say I only lose sleep when a client makes a bad decision that I couldn't prevent, because that's such a big part of our job.
Yeah, and I think that we're all striving to have a little bit more Paul in us, just being content in all circumstances, whether the market's up or the market's down. That's the benefit of planning, is it really shouldn't matter whether the market's up or down on a daily basis. It's about how this all fits into your plan and only taking the amount of risk that you really feel comfortable with or that your plan needs and supports. So with that, going towards the end of the year here, we touched on it last week. We don't have to get too far into it, but there are things we can do when we're above trend. It doesn't mean everything we own is up. What are a couple of basic portfolio and tax strategies that, if you want a deeper dive on this, we went into more detail last week. But Brian, just quick summary, what are a couple of things that investors can do on their own going into year end?
Yeah, definitely. We want you thinking about tax loss harvesting, of course. Not every stock you bought this year was well-timed and is at a profit. So go hunting for those losses. We talked about that this morning again in our group, just kind of looking for specific small tax lots. So there might be a stock that we bought once in December last year and then once in April, and the December lot might be at a loss and the April lot might be at a gain, and we've got to go find the specific shares we bought on specific dates, harvesting those losses. Don't forget to think of those losses not as a mistake but as a tax asset, something that can offset other gains you've incurred or even provide a tax deduction for you. Very important to go hunting for those tax assets. And then if you're in a low income year, looking at Roth conversions through the end of the year is something we'll be diving deep into next week with a lot of our clients, and then also looking at opportunities to actually sell at a profit, either to rebalance your portfolio or to simply harvest gains. So a lot of opportunities out there. Just the time's starting to get a little bit short. You have about 2 months to make those decisions if you want tax events to fall into 2025.
Yeah, and that I think is where we can wrap up today. Covered a lot of scripture, some easy tax planning tools before the end of the year. And is there anything else that you would add in summary, Brian?
I'd just say, big picture, this is an unusual market in some ways, but the behaviors are always going to be the same. So continue to seek wise counsel, be disciplined, always start with a plan first, and then place your investments second to fund that plan, and function based on contentment and a plan rather than greed and fear. That's a better formula for success.
Yeah. Thanks so much for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's conversation helpful, please like the video, subscribe to the channel, and share this with someone else who might benefit. For more resources just like this and timely insights, please visit our insights page at johnmoore.com, where we regularly share articles, videos, and tools to help you steward wisely. And we look forward to seeing you all next week.